A group of elders gets in a room every 6 weeks and determines what the price of money will be. And it doesn't matter where you are in the country. I mean, this is a country of 330 million people, 50 states, very different markets, and they kind of set the nationwide price. And then also because we're the global reserve currency, this has international ramifications. And so I just think the model itself is kind of antiquated, and that as software eats the world and as we kind of go through a somewhat inflationary crisis, I think the shortcomings of that model are kind of being laid bare. I think we can divide it into a couple different time frames. And so in the kind of the big macro scale, I've been using the framework of Ray Dalio, the long-term debt cycle. And so in that conception, it's the end of something big, right? But of course, the end is a long process, and it can be a decade-long process. So I think that basically, with the long-term debt cycle, every several decades, when you reach a massive amount of debt, when you go down to zero interest rates, and you have kind of just massive amounts of debt in the system, usually you go through some sort of currency devaluation and system change, right? So it's not the end of the world, but it's the end of an era, basically. And I think that's something we're seeing in a number of markets. But to get less doomy than that, if we focus more on the near term, we're in a cyclical downturn. And not all cyclical downturns become recessions, but some subset of them do. Back over the past, let's say pre-COVID, we had like a 10-year-long, economic expansion in the United States. We still had 3 cycles within that decade-long period of accelerating growth and then decelerating growth. And it just that the decelerating growth never became negative growth. It never became an outright recession, even though you had a couple near misses there. And so what we've been in over the past more than a year now is a decelerating growth environment. One of the big questions was, for example, why is Bitcoin not serving as an inflation hedge? And of course, that would extend to any sort of finite token. Why are these things going down when you ironically have high inflation of fiat currencies? And there's actually really good charts out there that show, Bitcoin in particular. I use that one because that's what most of the macro people will look at, because that's the biggest, most liquid one. And you'll see that, in rising global M2, so rising global money supply year over year, Bitcoin does very well in that environment. And now we're actually at a period where money supply is growing more slowly than it was a year or two ago. And you have multiple central banks, mainly the Fed, kind of pushing back and strengthening the dollar compared to many other currencies. And so when you translate all that back into USD denominated global M2 growth, it actually kind of came to a standstill. So ironically, now that price inflation is happening with a lag from monetary inflation, and some central banks are actually fighting back, it makes more sense as why we're seeing kind of downward price action in a number of assets, including Bitcoin and cryptocurrencies. And so analogs, I think, are actually really useful. But of course, there's no perfect analog. And if you go back far enough, technology is totally different. And so basically, the 2020s, are their own thing. But we still learn from periods of history. But I think that the base is to understand different analogs so that one can then see how they're different from that. If they don't study history at all, they're completely blindsided. They think it's all unprecedented, whereas actually there were rather similar environments. And so I think we can divide that into two parts. One is you mentioned Dalio's principles of, the focusing on that global reserve and rising and falling empires. And then that's different from maybe this current macro environment, even though I think they're related. So in that book, one thing he does, he'll take an empire and he kind of goes back in history. So there's, kind of the Chinese one, the United States one, the UK, the Netherlands. He goes back in time, maybe 500 years or so, and he tracks these handful of empires. And he grades them on multiple scales, right? So there's like their education, their military power, their economic size, their global reserve currency status, basically the acceptance of their currency by their various trading partners in other countries around the world. And there are some that are more leading and lagging than others. So education, for example, is a rather leading one, where that starts to rise before many of the others and then starts to fall before many of the others. Whereas the other ones, because of network effects and momentum that is, takes a long time to turn around, those are more lagging. And so global reserve currency is actually one of the most lagging ones, where all those other things come into place first, and then their currency gets widely accepted. And then even as some of those other ones start to clearly deteriorate, the global reserve currency is kind of the last one to roll over, because there's still so much network effect and usage for it that it's the incumbent. It's very hard to displace until all the other pieces are there. And so Dalio often points to China as kind of the rising power compared to the United States, which is in many ways compared to, the United States was the rising power compared to the UK. I think that there is some accuracy to that, but I mean, I don't think that, translates into, 20 years from now, we're all using the yuan, right? I think that's not what that means. I think that ultimately we're going to is, again, a more bipolar type of world, maybe a tripolar world, whatever you want to call it, but not this kind of unipolar world. I mean, after World War II, which is maybe the closest analog, because that was the rise of the United States over the United Kingdom, most of the world was devastated. The United States was kind of like almost untouched, right? And so we were rebuilding our allies. We were helping rebuild some of our enemies. I mean, we had kind of the last intact manufacturing base, and that was kind of becoming like a hyperpower status, which is pretty rare in history. And so outside of something like that happening, I think that the era we're going into is somewhat more decentralized, somewhat different poles, and just you have the relative diminishment of the United States. I mean, we have something like 4 or 5% of the population. At our maximum height, we were like 2/3 of global currency reserves, and that's kind of an inherently unstable system. It's hard to maintain that level of dominance, and I think we're naturally drifting towards where's the population centered, where are these different sources of power, and so I do think that we're headed in that direction. And then tying it into historical analogs in other areas, like what is this inflation similar to? What is this economic environment similar to? I have been using the 40s as the closest comparison. And the reason I've been doing that is so when people think of inflation, they often think of the 70s, right? So they just go, that's the one they think of. But the environment was quite different and the causes of inflation were quite different. The one similarity, I think, was the shortage of energy. But outside of that, most of the money supply growth in the 70s was you had a demographics boom. The baby boomers were entering their home buying years. You had a lot of bank lending happening. And so, when commercial banks make loans, that increases the broad money supply. And then, of course, on top of that, you had some fiscal problems, but the deficits are actually much smaller. And a lot of that broad money supply was happening because of the banks. You also had pretty low debt as a percentage of GDP. And so, Paul Volcker, for example, the head of the Fed at the time, could raise rates to double digits to try to, kind of purposely put the U.S. in a recession, stabilize the dollar for international creditors, and go from there, right? So I think it's both the causes and solutions to inflation were quite different than what we're seeing today. And actually, I think a closer analog is the 40s, which was, you didn't have a lot of bank lending, you didn't have a lot of demographic expansion, but you had, after the 30s, actually, let's go back to the 30s. So you had this, obviously 1929 crash, and you had a decade-long depression, and you had rising populism, both between countries and within countries, and that took different forms. I mean, obviously in Europe, you had the rise of Nazism, and that obviously contributed to global conflict. You also had populism in the United States, multiple other countries, because of that tough economic environment. And then eventually, when you ran into the 40s, and you started to get that conflict happening, and you worked out a lot of the leverage in the system, you had huge fiscal expenditures, right? Because a lot of it was to fight the war and to kind of rebuild things after that period of stagnation and populism. And so the inflation that we saw in the 40s was very fiscally driven. It wasn't bank lending driven, it was very fiscally driven. So you had a sharp increase in the money supply, and you had very high public debt to GDP, which means that the central bank couldn't raise rates to double digits because you'd bankrupt the federal government. And so they just held rates low anyway, despite significant inflation. And you had this huge fiscal driven inflation. And I think that, what we've seen over the past, call it 15 years, has kind of been a replay of that, where we had the 2008 crash. In many ways, I have a whole bunch of charts out there that show it's very similar to the 29 crash in terms of it being a private debt bubble that unfolded. And then, throughout the whole 2010s, we had what in many ways was a mild depression.